Hello and welcome to Lecture 10 of Financial Statement Analysis. Today's topic, Valuation 3, we look at estimating the cost of capital. We're still in step 4 of our business analysis framework, and this is the final part of learning how to actually value a business. Last week we looked at the valuation models, like the residual income model. This week we're learning how to estimate the cost of capital so that we can actually fully implement those valuation models. So we've got a very simple learning objective today, how to estimate the costs of capital, and we're going to go through 3 different costs of capital. So to revise what we did over the last 2 lectures, we learned how to value a business using 4 different valuation methodologies. We used the dividend discount model, the residual income model, the discounted cash flow model, and the residual operating income model. So when we valued those businesses, we had to present value either the dividends, cash flows, residual income, or residual operating income. To do that present value calculation, we needed to have what's called a cost of capital. So the cost of capital is what we use to actually do the discounting to calculate the present value of these future cash flows or earnings. So today's lecture, our goal is to understand how do we actually come up with the cost of capital estimation. When you invest in a business, there's a range of different possible outcomes that may occur. You don't know with certainty when you invest your money what's going to happen with that business. They could go on to be the next Amazon and super successful, or they could declare bankruptcy the following day, and any of those options in between could occur. There's lots of different paths that an investment might take. So when you invest, there's a whole range of different possibilities that could occur, and they each have their own probability of occurring. And most people are going to be risk averse. That means if you take on more risk, you're going to want to earn a higher return for that given risk. So when we're looking at the cost of capital, we need to think about risk and return trade-offs. And as we invest in a business that is riskier, we'll want to earn a return that is higher to compensate us for that risk. There's a lot of terminology that we've used in previous weeks and you would have heard of in different subjects that all refers to a very similar concept. So today I'm going to be using the term cost of capital a lot. It also has similar terms such as the required rate of return, the discount rate, the expected rate of return, or the hurdle rate. These are all very similar concepts, and these terms will often get used somewhat interchangeably. So what is the cost of capital? The cost of capital is the return investors require to actually invest their capital into a business. There are 2 sources of capital that can be invested into a business. We've got debt and equity. And if you think about your first accounting lesson when you learn the accounting equation, the assets of a business can be funded with either liabilities, which is debt, or equity, owner's equity. So there's 2 sources of capital. You can either have debt or you can have equity. And risk and return are correlated. So as a business takes on more risk, investors would want to be compensated with higher returns. For a given company, equity is always going to be riskier than debt, and we'll discuss that later. And the cost of equity is therefore going to be higher than the cost of debt for any particular firm. These are the 3 terms that we've used previously in our valuation models, and we're going to look at in more detail today. The first one is RD, which is the cost of debt capital. Simply, this is the interest rate that a company will pay on its bank loans or its bonds. So the interest rate on its debt, we call that the cost of debt capital, or the cost of capital for debt. RE is the cost of equity capital, and that's the return an equity investor is going to require to invest in a risky project. And finally, we've got R of F, which is the cost of capital for the firm, and that would be a weighted average between the cost of debt capital and the cost of equity capital. If we go back to our balance sheet, this is like the cost of the capital for the assets, and it's a function of the liabilities. Let's look at the cost of debt capital to start with. The notation we use in our formulas is RD to represent the required rate of return on debt, or the cost of capital for debt. And in simple language, it's going to be the interest rate that a business has to pay on its borrowing, such as bank loans or bonds. As a simple example, if firm A goes to the bank to borrow 100 million and the bank offers firm A a loan at 5% per annum, then their cost of capital would be 5% per annum. Firm B goes to the bank and the bank only offers them a loan at 6.5% per annum. So their cost of capital for debt would be 6.5%. The bank required a higher return on firm B relative to firm A because they perceived that firm B was a riskier investment. So even though both firms were borrowing 100 million, The bank might have looked at the financial statements of firm B and seen them to be a riskier business, so they charged a higher interest rate. As the risk of a firm goes up, the interest rate or the cost of debt capital will also increase. Now I want to look at Gale Pacific to think about how we could find out what their cost of debt capital is. So here I've got their balance sheet for 2019. And as I go down to their non-current liabilities, it's got the borrowings. It says we could look at note 17 to find more about this $14 million that they've borrowed. So when I open up note 17, it says, for your bank loans of $14.956 million, refer to note 22 for further information. So I'm going to go to note 22, and in note 22 on financial instruments, they've got interest rate risk, and it says for their bank loans, they have a weighted average interest rate of 3.47% this year. The prior year, the weighted average interest rate was higher. It was 3.74%. So this makes sense. During the year, we know interest rates broadly for the economy have decreased, and Gale Pacific, even though they've borrowed more money, because the interest rates economy-wide have decreased, they are paying a lower interest rate this year. So this is going to give us a good idea of what we would expect their cost of debt capital to be, the amount that they're paying on their borrowings to the bank. Furthermore, when we did our ratio analysis, we calculated the NBC, the net borrowing cost. So the net borrowing cost of the firm is essentially the interest rate they're paying on their borrowings. So that's also going to give us a good idea of a firm's cost of debt capital. So the net borrowing cost, NBC, is equal to NFEAT, our net financial expense after tax, divided by average NFO, the net financial obligations. So in plain language, the interest rate is going to be equal to the interest the business has paid divided by the amount borrowed. The interest paid is our NFEAT, and the amount borrowed is the NFO. So for Gale Pacific 2019, I've got their NFE and their average NFO, and I'd get a net borrowing cost of 3.66%. If I flick back, it's somewhere between these two estimates of the bank loan debt, which makes sense because I've used an average of these two NFO figures. We have used an after-tax calculation because interest is tax deductible. So when I had NFEAT, it takes into account the tax shield. So it makes sense my net borrowing cost here is a little bit lower than the interest rate they had to pay. Okay, so if I'm estimating the cost of debt capital for Gale Pacific, I can look at their financial statements and see what interest rate they're paying to their banks. I can calculate their net borrowing cost and come up with an after-tax number, and we can see that they're pretty similar in this case. Furthermore, if your firm borrowed money via issuing bonds, now this is really common in the US, but not as common for Australian firms, we could look at their cost of debt capital from figuring out their effective interest rate on their bonds. So if a company, for example, goes to the bond market to borrow 100 million, a ratings agency such as S&P or Moody's will rate the firm. They'll give a likelihood of the firm actually paying back these bonds. So the highest rating is AAA. So firm A has a AAA rating. They could borrow money at the moment at about 2.07% in the bond market. Another firm, firm B, they're the risky one. Moody's give them a CCC rating, which is a really low rating. And the current interest rate for a CCC rated investment is about 16.95% on average. So when Moody's did their financial statement analysis on these two firms, they said firm A is really almost risk-free. They've got a lot of cash. They have a very low debt to equity ratio. Their earnings cover the interest really easily. They're going to be a safe investment. Low interest rate. Firm B, on the other hand, current ratio is horrible. Their times interest earn coverage is horrible. They've got a lot of debt to equity and their industry is in a bad position at the moment. Very risky, highly likely to go bankrupt. 16.95% interest would be required to tempt an investor to even take on this loan. So let's look at some real numbers here for bonds. So your company may not have bonds issued because, as I said, it is kind of rarer for the Australian companies. But if you're going to value an American listed company, you'd probably be able to find that they have bonds issued, and you'd be able to look at the yield on their bonds, and it'll be very closely related to how their bond is rated by S&P or Moody's or Fitch, which are all bond rating agencies. So for US corporates with a AAA bond rating, at the moment they've got an average interest rate of about 1.73%. So if you were valuing a company that had a AAA rating and you wanted to know their cost of debt capital, it would be somewhere around 1.73%. You can see how it's changed over the last few years. Interest rates change over time. Firms change their risk level. And the macroeconomic thing, the interest rates will change over time. The long-term average for AAA rated bonds is 4.19%. We're at historic lows. Even 1 year ago, it was 3%. So in the last 12 months, the cost of debt capital for these AAA rated firms has decreased by 43%, from 3% down to 1.73%. So it's almost halved. If we look at different ratings, an A-rated firm, which is less than a AAA, 2.07% at the moment would be their cost of debt capital on average. Again, it's decreased. It's much lower than the long-term average. It's decreased from a year ago. Triple B, currently 3.11%. So the spread between a AAA and a triple B is not huge, a bit over 1%. But then we look at the lower rated companies, the triple C rated companies. Currently, they need to pay about 16.95%. A year ago, that was about 11%. So in the current coronavirus situation, remember I sent an article a few weeks ago looking at zombie companies and how the current coronavirus pandemic might make a lot of companies go bankrupt because they, even in the good times when they could borrow, they weren't really able to pay their interest effectively. Now when it's harder to get borrowings, a lot of these firms might go bankrupt. The risk relative to a year ago of investing in a triple C rated bond has increased, so the interest rates have gone up. Whereas for the AAA, the A and the B rated companies, their interest rates had gone down. So when we do our macroeconomic analysis and we look at interest rates, even for different sections of the market, for different industries or different rated instruments, things might happen that affect one firm differently to another. The cost of debt capital for an A-rated firm has decreased in the last year. The cost of debt capital for a triple C-rated firm will have increased in the last year, quite substantially. So to conclude on the cost of debt capital, when we're doing our formulas, it's represented as RD. It's simply the interest rate that companies have to pay on their borrowings. The common source of borrowings is going to the bank or going to the bond market. But there can be other more complicated ways. But to keep things simple, check out the interest rate on the bank loans or check out the effective interest rate on the bonds that your company has issued. Then you'll see that, and that should be very similar to what you've calculated as their net borrowing cost. The key reason to use the net borrowing cost formula for the cost of debt capital is that it's an after-tax rate of return, which is important because when we do our discounting in our valuation model, we're valuing after-tax dividends and cash flows and earnings. Okay, so when you're then forecasting your cost of debt capital in the future, forecasting future NBC is a function of changing firm risk. If your firm's borrowing more or industry's becoming more competitive, you're in a struggling industry, any of those things could mean that your net borrowing cost will increase because the firm's risk is changing. But at the same time, in the current environment, macroeconomic trends are meaning that the interest rates, like the Reserve Bank of Australia's interest rate or the Federal Reserve in the US, they're lowering interest rates. So these two factors need to sort of be balanced out. If your firm's risk is not changing, then the macroeconomic trend would lead to a decreased NBC in the future. If your firm's risk is increasing, then you might need to forecast that their net borrowing cost may increase as they become a less viable or a more risky company. Now I'd like to talk about the cost of equity capital. The notation we use is RE for the return on equity. Investing in equity is going to be riskier than investing in debt for a particular company. So the reason why equity investment is more risky than debt investing is because during bankruptcy, debt investors are higher up the pecking order and they're going to get paid back before equity holders. So if we've got a business that owns a lot of assets and they end up going bankrupt and having to sell off all their assets, any cash from the asset sales will be given to debt holders before it gets given to equity holders. So in the worst case scenario of a business failing, if you've lent money to the business, you're more likely to get paid back than if you have invested in equity in the business. Furthermore, debt investors may require collateral or mortgage for a loan. So a bank might lend you money for the house, but if you can't pay back the loan, they get to keep the house. Okay, so in the worst case scenario, they are secured somewhat of bankruptcy. Debt investors have predictable and contracted interest repayments and principal repayment schedules that are agreed to in advance. This means there's less volatility in the payments that are made to debt investors. Compared to equity investors, dividend payments are not guaranteed. They're up to the discretion of the board of directors, and they can change year to year. This year, a lot of companies have decided to cut back their dividends or cancel their dividends completely, which is a risk to equity investors who are relying on those cash flows. So the cost of capital for equity is going to be higher than the cost of capital for debt for a given firm, because being an equity holder in a firm is riskier than being a debt holder in a firm. Now, when it comes to estimating the cost of equity capital, the cost of equity capital can't be directly observed. We know it exists, but we can't just look at a financial statement and pick out this number. As a simple example, if I offer you an investment in my business and I say, hey, I want you to invest $1 million in my company. My company's got this fantastic idea, and I explain my idea to you and we go through the numbers, and you think at the end of the couple of years, maybe at the end of 10 years, based on your $1 million investment, you think you would expect to earn, say, 1%. You'd say, okay, Matt's got this business idea. He wants me to give him $1 million, and he's promising me a 1% return after 10 years. Immediately you'd say, that doesn't seem like a very good deal. I'm risking $1 million, his business might fail, and all he's promising me is a 1% return. You'd say that's not enough of a return for the risk. I could put the money in a bank account and earn higher than 1%. Okay, so you know that if you get offered an investment and you don't think the returns are high enough for your liking, you would say no to that investment. If on the other hand, I had an investment that I said, oh, invest in my business, and we figured out the numbers and you thought you were going to earn 100% return, that sounds really good. You'd be really happy to invest in that. However, I could probably offer that same investment to other people at a cheaper rate, and they might be willing to invest for a 20% return. Okay, so the cost of capital for equity depends on people's risk levels and the expected payoffs of a company. You would never invest in a company that's only going to return 1%, but it's unlikely anyone's going to offer you an investment that would return 100%. And somewhere in between would be our cost of equity capital. We can't observe it directly, so we need to estimate it. We've got two estimation techniques we're going to look at in this subject. The first one is the most common one, and it's called the capital asset pricing model. And the second one is called FarmerFrench factor models, and they're based on research by Eugene Fama and Kenneth French, who are both finance professors, and they won a Nobel Prize for some of their work in finance. So first of all, we're going to look at the cost of capital for equity estimated using the capital asset pricing model. The capital asset pricing model is also called the CAPM, C-A-P-M, CAPM. And the CAPM is based on this really nice theory, and it says that the market, so the share market or investment markets, will not provide investors a risk premium for any risk that could be diversified. So as you invest in more and more companies, a lot of the risk that you take on dissipates or disappears, and then you get left with what's called market risk. So if I own shares in every company in the Australian economy, I'd be taking on market risk, but I wouldn't be taking on any idiosyncratic risk for just having one investment. So the CAPM says that because investors can diversify their returns, the only risk that you should get paid for is taking on the market risk, because any other risk can be arbitraged away. So using the capital asset pricing model, the cost of equity capital for a firm is equal to the risk-free rate plus the equity risk premium times the company risk level, which is represented with this B for beta. So the theory for the capital asset pricing model makes sense that risk and return is linked together, but the only risk that investors should actually get paid for is market risk, that is taking on any investment risk. Because all the individual risks with a single investment, they can be diversified away by having a diversified portfolio of stocks. So the capital asset pricing model says the cost of capital for equity is going to be equal to a risk-free return. That is, if you invest in the risk-free assets, you'll get some sort of maybe 1 or 2% return for taking on no risk. And we'll talk about that soon. Plus the company's beta, which is its correlation with market returns, times the market risk premium. Okay, so the formula here in the blue box, the return on equity or the cost of equity capital is equal to the risk-free rate of return plus your company's individual beta times the return on the market minus the risk-free rate. This term in the brackets here is called the market risk premium. The return on the market minus the risk-free rate is called the market risk premium. The capital asset pricing model's beta is the sensitivity of the investment's return to the market return. How well correlated your company's stock returns are with the broader market. So we've got our capital asset pricing model formula. The return on equity is equal to the risk-free rate plus the company's beta times the return on the market minus the risk-free rate. The first term we want to look at is the risk-free rate. What is the risk-free rate? Well, first of all, it's a theoretical concept. There is nothing in the world that is completely risk-free, but for our purposes, we want to imagine there's something that's risk-free. And the closest thing we can think of that is risk-free would be government debt. The Australian government have a printing press and they can keep printing more money. So if they lend you some money or if they borrow money, they control the money supply. So if they're issuing bonds and they borrow money, you can guarantee that the Australian government will pay back under normal circumstances, because even if they don't have the money, they can get that printing press going and print off some more money and pay you back with that. So it's a relatively risk-free rate. Now, governments have been overthrown around the world, and investments that seemed risk-free for countries that have been successful at one point, sometimes those governments get overthrown, currencies change. So government debt is not perfectly risk-free, but it's the closest we can get to it. So when we come to estimating this number, the risk-free rate, what should we actually use? Well, the practicality of it's difficult. If I'm investing in an Australian company or a multinational company, what risk-free rate should I use? Here are some of the choices that people make, and there's no best answer. There's no perfect answer for this. It's an estimation that has lots of error involved. We could use Australian government bonds or notes, and I've said, for the assignment, as a recommendation, you could use the RBA cash rate, go on their website and check out their cash rate. If you're valuing a company that is multinational, you might look at US government bonds or notes. But at the moment, they're such historically low levels. Is that really the risk-free rate, or is it just the risk-free rate this year? You could look at historical averages rather than current rates if you think the current rates are artificially low. So there's lots of choices on what risk-free rate to use. None of them are perfect. There's no best estimate. Different people use different risk-free rates in this model. This figure here is from a paper which I'll cite later, and it shows the historical Australian government bill and bond returns. So in the blue dotted line is the government bills, and the red line of the government bonds, and we can see they've fluctuated a lot over the last 140 years. They got to highs between 15 and 20% per annum, and if we extend it out to 2020, they would be at historic lows, getting under. Okay, so they'd be very volatile. So when we use this model and we choose a risk-free rate, do you base the risk-free return depending on what year you're doing the valuation, or do we want to take an average over historic? The choice is yours on what to do there. If you do go through and use the RBA cash rate, here's a little screenshot from the RBA website, which has their current cash rate graph and how it's changed over the last 30 years. So if you want to use the current rate, you can. If you want to use some sort of average, you're welcome to do that as well. Next up in the capital asset pricing model, we've got the term beta. The beta of a firm is the covariance between firm I's return and the market return over the variance. So it's a correlation measure. It's a correlation between, as your stock price goes up and down and up and down, is it going up and down at the same time as the market in the same direction? Is your company's stock return correlated to the broader share market stock returns? If your firm has a positive beta, it means that the firm's stock returns and the market stock returns are moving in the same direction. A beta of 1 indicates the firm's return is perfectly correlated with the market. So if you see on the news today, the Australian Stock Exchange, ASX or S&P 200 has gone up by 2%, then you would expect your firm has also gone up by 2% if you had a beta of 1. If you've got a beta above 1, it indicates your firm is riskier than the market. That is, if the stock market for the year went up 10% and your firm had a beta of 1.5, you would expect your company went up by 15%. But the downside's true as well. If the stock market decreased by 10% this year and your firm had a beta of 1.5, you would expect your firm to have lost 15%. Okay, so it magnifies the increases, magnifies the downside as well. And a beta below 1, you're less risky than the market. You don't go up as much when the market goes up. You don't go down as much when the market goes down. Negative firms, it's a bit rarer, but you're not correlated with the market. Your stock price goes in the opposite direction to the broader market. I've said for your assignment, you can get a beta estimate from a financial database such as Yahoo Finance. Okay, so even though I've given you the formula here, we don't expect you to calculate it in this subject. You can just get beta from Yahoo Finance or Data Analysis or any other financial website. If you are interested in calculating it for yourself, then here's how you'd go through and do it. First of all, you have to choose an index benchmark. So when we say, how does your firm's return correlate with the market, what market are you using? The All Ordinaries, the ASX 200, 500, all companies on the market. You have to choose a benchmark. Then you choose a time frame. Am I going to look at how the market return and my company returns correlate over a month, a year, 10 years, some sort of time period? Your choice. Everyone does it differently. You download prices. You could do daily, weekly, monthly share prices, similar for the index. And here we've got Qantas's share price changes each day compared to the ASX 200s. Okay, you calculate the percentage change for the day and the percentage change for the market. Then you can do a covariance function in Excel here to calculate the beta. Here we've calculated the beta for Qantas is 1.23, but if I look on the Yahoo Finance website, it's 1.17. How could they be different? Maybe Yahoo's used a different time frame. Maybe they didn't use the ASX 200. Maybe they used the All Ordinaries, which is 500 companies. Maybe they did weekly or monthly returns. Every part of the calculation of beta, people do it slightly differently. So we're always going to get various different beta estimates for a firm. Next term of the capital asset pricing model we want to look at is RM, which is the return on the market. So what is the return on the market? It's a theoretical concept that is aiming to take into account that no matter what investment you do, whether it's stocks, bonds, property, commodities, artwork, or Bitcoin, any risky endeavor that you can think of that you can invest your money into, the returns of those endeavors should get captured in the return of the market. So the return of the market is the return on all investable assets in the world. So obviously that's actually impossible to figure out. So it becomes a bit of an issue. What is the return on the market? Well, we can't measure the return on everything. Practical options to use would be maybe an Australian stock return average or a US stock return average, or maybe even a worldwide stock return average, just as kind of something that we can actually implement that tries to get at the concept. If we're valuing an Australian company, should it be an Australian market return, or should we always use global returns? There's lots of unresolved issues here. So for the return on the market, we have to come up with some sort of estimate of the overall risk that investors will take. And then we have the term market risk premium. So the market risk premium is the bit inside the brackets here, the return on the market minus the risk-free rate. That is the premium above the risk-free rate. Okay, how much do investors demand on their investments? So the return on the market and the risk-free rate are both estimates. So the market risk premium is also therefore going to be an estimate. What can you use for this market risk premium? Well, some practical options to use. You could use this paper, which looks at the historical equity risk premium in Australia for the last 128 years. They find that the observed equity premium has averaged 6.1% or 6.5%, depending on if they use government bonds or government bills. Okay, so for the risk-free rate that they either use Australian government bonds and they get a 6.1% risk premium, or if they use Australian government bills, they get a 6.5% risk premium. Okay, so that's a nice historical number that you could use. It's been over 128 years of data, a long time has been the average. Another paper you could look at, the market risk premium. This is an international study looking at over 69 countries and what practitioners have actually been using for their market risk premium. So you could have a look at this paper and check out what numbers are used around the world and what would be appropriate for your firm, which is probably operating in Australia or New Zealand, or maybe it's got operations in the US. So that would be Air New Zealand, Boral and CSL have big US operations, and some of the other companies like Flight Centre are more Australian based. So that gives you some ideas of how to practically implement the risk premium number in your CAPM model. So let's recap some of the issues. We've got this model called the capital asset pricing model. It's used to calculate the cost of equity capital, or RE. However, the estimates of the cost of capital are made using market prices. When you do that beta estimate, share price changes compared to market changes, it's assuming the share market is efficient when you're calculating beta. So we're making an assumption the share price is efficiently valued, then we're going to try and fundamentally value it well, if the market's efficient, our fundamental valuation should be very similar to the actual price. So little bit of a weird paradox there. The model, when you do the maths and do the derivation of the model, it assumes that stock price returns are normal. And we know stock price returns aren't normal. They're bound at minus 100%. You could lose all your money. But on the upside, a company like Amazon over the last 20 years has earned thousands of % return. So they're not normally distributed. They don't have the tails that go out on either direction. It's bound on one side. It's got a positive average. So one of the assumptions in the maths is incorrect for CAPM. We've got this term, the risk-free rate. We don't know what the risk-free rate is because nothing is risk-free. Then we have a decision, should we use current government risk-free rates, such as government bonds or bills? Should we use historical averages or current rates? Is the risk-free rate changing over time or should it be constant? Similar for the market premium. What market do we look at? Australia, the US, globally? Do you expect that would change over time or should it be a constant figure? Then we get the term beta, and we just did a very brief sort of description of how beta is calculated. There's lots of choices you have to make in the beta calculation. All of those choices lead to different beta estimates. So there's no one correct beta for a firm. There's thousands of different beta estimates that could be realistically achievable that might be appropriate, but they'll all lead to a different cost of equity calculation. So this guy here, Warren Buffett, our favorite investor in this subject, he said that the CAPM is seductively precise. It gives you this exact cost of capital number from the formula. Looks good, theory's all right, but we know practically in implementing the model, there's a lot of difficulties, and it can lead to some strange outcomes sometimes. A paper that I've linked to here by Welsh finds that 75% of professors recommend the use of the capital asset pricing model. This survey paper of company CFOs found 74% of chief financial officers actually use the CAPM in their work, but then they found that a lot of practitioners don't actually apply it correctly. As we just went through, there's a lot of different issues, a lot of places that you can make mistakes with the application of this. So researchers, when they've looked at the capital asset pricing model, have found that it's not perfect. There's a lot of estimation errors when we apply the capital asset pricing model. It doesn't perfectly predict future company returns. It doesn't even perfectly predict historic returns. So researchers have been trying to figure out how to improve the capital asset pricing model, where it gets things wrong. And two very famous finance researchers, Eugene Fama and Kenneth French, they came up with this model in 1992 where they said, okay, there are all these things that help explain stock prices that are different to beta. And they found that the size of a company and the book to market ratio also help explain a company's returns in addition to the beta from CAPM. So they created a model called the FarmerFrench 3-factor model. It takes into account the company's beta, the size, and their book to market ratio. And it does a better job of estimating future stock returns than just the CAPM model. However, there's no real theory for size and book to market explaining the stock returns. It's an empirical finding, and people aren't sure if they're risk factors or if they're market inefficiencies or pricing problems. There's a lot of ongoing debate there. Subsequently, these guys, Fama and French, they're both Nobel Prize winners in finance, so they know what they're doing. They keep looking through and finding other things that explain stock returns. They've also found that investment and profitability, as well as momentum, help explain stock returns. So now there's 5 or 6 factors that help explain stock returns. So we don't just use beta, we use all these other methods as well. The implementation of this model is outside the scope of financial statement analysis. It's more of a finance kind of subject, but you have to run some regressions and figure out these different factors for the stock markets. It's quite an involved process. So not many sort of CFOs would actually be applying this model. It's more something that academics do that is more accurate than the capital asset pricing model, but it's a lot more involved in actually running these models and getting the cost of capital from them. So as I just mentioned, you don't need to know how to apply the FarmerFrench models in this course, but I want you to know that there are these other models that improve on CAPM. They take into account pricing patterns such as small firms. Here we go, the Australian firms. Small firms, on average, small firms have higher returns than big firms. Okay, this is using Australian data from 91 to 2000. Same story if you do more up-to-date data or international data. We know that small firms seem to have higher returns than big firms. There's no theory behind it, it's just an empirical finding. So if we take into account the firm's beta and the firm's size, it does a better job of predicting stock returns than just using the beta. Next, low book to market firms generally have lower returns than high book to market firms. High book to market firms, the book value of their owner's equity is high compared to their market value of equity. These are often considered to be value stocks, and we have an expectation that their stock returns might be higher in the future. So again, this model includes beta, firm size, and the firm's book to market ratio to help predict future stock returns or to predict their cost of capital. And here's a recent paper published in 2016 using Australian data and the 5-factor model, which included the investment, profitability, and also momentum factors. So what do I want you to know about the FarmerFrench model? The CAPM's not perfect. Researchers have been working very hard to try and improve it. One of the improvements is called the FarmerFrench factor models, and it takes into account other known predictors of stock returns, which allows us to come up with more accurate cost of equity calculations. However, the FarmerFrench models are difficult to implement. You need to be able to get share price data for all the companies on the market every day, calculate these different factors, which is a bit complicated, then run regression models on each of the companies you want to do. Similar to beta, then, you've got issues about how long do you run these models, what time period, what's the market include. There are still implementation issues. Okay, so they're an improvement, but there's still problems. Difficulty, most people wouldn't be able to run these models, and there's not a very good theory behind a lot of these factors. It's more just data-driven empirical findings rather than theory-based. We're now moving on to a different calculation. We're going to be looking at the cost of capital for the firm. You may have seen or heard of the weighted average cost of capital, and that's what we're going to use to calculate the cost of capital for the firm. So earlier on I said a business is financed by both its debt and its equity. Assets equals liabilities plus equity. We looked at the cost of capital for debt, and we've also looked at the cost of capital for equity. Now, if we want to think about the assets of the business, assets equals liabilities plus owner's equity, we can use what's called the weighted average cost of capital to calculate the cost of capital for the firm. The cost of capital for the firm is calculated using the firm's net financial obligations. So from our reformatted balance sheet, how much debt does the business have? You divide through by the debt plus the value of the firm's equity, current market capitalization of the firm, times the cost of capital of debt that we previously talked about. We then plus the value of equity, that's that market value of equity from the number of shares times the current share price, divided through by our NFO plus the value of equity, times the cost of capital of equity, which we talked about calculating using the capital asset pricing model. So we get how much debt to equity we've got, times our cost of debt, plus how much equity to total firm value we have, times our cost of equity, gives you a weighted average of your cost of capital. Okay, so I've got a little note here. For your assignment, and this is the weighted average cost of capital can be implemented in different ways. For your assignment, instead of using the value of equity as the number of shares times the share price, I'm saying, why don't you use your residual income model to value the shares and put that value in this model rather than the current share price times the number of shares. Different people do it different ways. If you do the number of shares times the current share price, it's taking into account the actual value of the company as an input into your valuation. So it's a bit of a circular logic. So for this value of equity, use the residual income model just to try and keep things a little bit more enclosed and consistent in your modeling. So to finish off, once we've got the weighted average cost of capital, which is calculating the return for the firm, it gives us some insights. We can break down how our overall cost of capital is split between our cost of debt capital and our cost of equity capital. We can think about how the cost of capital for the firm compares to the actual return on equity that the business is generating and where it's actually generating those returns, what its financing risk is compared to its operating risk as well, how that plays out in the overall cost of capital for the firm. Okay, so we've concluded the discussion on the cost of capital. There's a few practice questions in the following slides that you can look through just to make sure you know how to apply the calculations. You can check out the Gale Pacific spreadsheet, which has got some updated calculations for the cost of equity and the weighted average cost of capital there. Now that we've completed this topic, you can complete your valuation models. Next week, the topic is application. We're going to talk through a few of the remaining issues in valuation and how valuation gets applied in the context of mergers and acquisitions and other professions, management consulting and that sort of thing. Thanks, guys, and I'll see you next week.